Joining us now first on CNBC is PepsiCo Vice Chairman and CFO Hugh Johnston. He's a member of the CNBC Global CFO Council. Hugh, always good to see you. Thank you for coming on Squawk on the Street.
Great to see you as well, Jim. Good morning.
All right, let's get right to it. There are a lot of people, Hugh, who say that basically you did not raise forecast. But I see that you pivoted toward a higher growth rate than Wall Street expected. And to me, that means, particularly against a very tough quarter, that you really are being rosier than Wall Street thought.
Yeah, Jim, I would agree with that. As you noted earlier this year, we really made a move to pivot towards higher growth, investing back in the business in a much more significant way than we had previously. And we're doing it across the board, advertising and marketing, our selling capability, our manufacturing capability. All of that money is going back into the business with the goal of accelerating our growth for both us and for our customers. And frankly, it's working really well right now. We've seen it over the course of multiple quarters at this point. We're seeing it across a broad base of businesses. So we really feel good about the third quarter and how the year has gone so far. And that's why we raised our revenue guidance for the full year, because as we look at things, we do see a positive picture.
All right, so you know I walk the aisles in the supermarket. To me, it seems like the aisle that is carbonated, you picked up share against Coca-Cola. The aisle that is Frito-Lay, it looks like you took maybe a couple yards of share with some of these new hot products. Is my square footage right?
Yeah, we're certainly doing better in terms of space in the market, both in terms of the aisles as well as the perimeter of the store as well, where a lot of the sales happen because our products are so impulse. I think what's happening more than anything is the increased advertising that we have is causing consumers to shop us more aggressively, and our customers are rewarding us with that space because they know that we can help them grow, and that's a big challenge for them. So the snack food business as well as the beverage business really have good momentum right now, competitively as well as supporting our customers.
I hate to say this, but you and I are old timers, and you remember the days when we used to focus on Gatorade and the growth in Gatorade and how important it is. Can that be happening again? I see very big numbers, Gatorade.
Yeah, I think we've got good momentum in that Gatorade business right now, and it's a combination of a couple of things. Number one, just the increased advertising level and the quality of the advertising, I think that has picked up quite nicely as well. In addition to that, Gatorade Zero is just a terrific new product. It's the biggest zero-calorie isotonic in the marketplace by far, even though the product is just a little bit over a year old. And then in addition to that, we just launched Bolt 24, which is for athletes off the field of play, where they can actually meet their hydration needs all day long. And that product is off to a great start. So I'm very bullish on the Gatorade business right now. I think we've got terrific momentum there.
Hey, Hugh, speaking of advertising and marketing, do I have this figure right? Tracking up 12 for the year? And how long can you sustain that?
That's correct. Yeah, we've seen a nice pickup. Listen, as we see our sales accelerate, I think you'll see us continue to pour money into advertising and marketing because it's having the desired effect. And importantly, we're getting good returns on that advertising. Obviously, as the CFO, I watch that pretty closely. And we are seeing good positive financial results out of the increase in advertising, not just increased sales. So, yeah, 12% is correct, and I think we'll continue to increase at a good, healthy clip.
So your investor base seems to get it. Would you agree? I mean, you obviously have the increase in SG&A, but they're not concerned about it because it does seem to be driving that organic sales that you're talking about.
That's exactly right. The increase in SG&A is primarily driven by investments in selling capability to go along with our advertising and marketing increases as well. So the investor base understands putting money into these areas results in a stronger, more sustainable franchise. To put it in financial terms, it extends the duration of strong performance. So I think the investor base understands that. Combine that with the fact that we've got $1 billion productivity program going on this year, so we're reducing non-value-added costs and investing in costs that actually drive the success of the business. I think investors appreciate that, particularly in today's choppy and challenging environment for them.
Okay, you've got about 15 seconds. Everybody tells me the economy's slowing. Look out. How bad is it for PepsiCo?
You know, Jim, I can speak for our business, and what we see is a consumer that really likes our products and is buying them at an increasing rate. So as far as we can tell, the consumer is actually doing just fine right now.
Well, there you go. I mean, I know that we're supposed to be hanging ourselves, but looks like while we're hanging ourselves, we're still drinking PepsiCo and having a couple of snacks. Hugh Johnston, thank you so much.